which is on co-lending model, creating new opportunities, transforming and bridging the unmet credit gaps in the economy. One of the most important tenets of the financial inclusion is easy and on-time access to credit at a reasonable cost, irrespective of geographical location. India is still a credit-hungry nation, and this unmet credit gap serves as both a challenge and an opportunity for the financial service providers. To take the discussion forward on this interesting topic, Mr. Sanjay Sharma, co-founder and managing director, iFinance, is here, who will be orchestrating this discussion. Can we have a round of applause, please, for Mr. Sanjay Sharma here? Joining us, we have Mr. Steve Hudgrave, CEO and co-founder, Varthana. If Mr. Steve could join us on stage. Thank you so much, Mr. Steve, for joining us here. Round of applause, please. Mr. Dheeraj Mittal, Chief Operating Officer, Hiranandani Financial Services. Thank you so much, Mr. Mittal, for being here with us this afternoon. Ladies and gentlemen, please welcome Mr. Dheeraj Mittal here. And Mr. Nirav Choksi, co-founder and CEO, Credible. If Mr. Choksi could join us on stage, please.
First of all, thank you for being here today and for being a part of the audience for this discussion. The topic that we are going to talk about is about co-lending and whether it is the secret key that is opening up the access to people who are so far excluded from credit access or who were less serviced. And we have a panel of practitioners who understand this industry quite well. So I think those are the questions that we will pose to them. And later on, I'll open it up for audience questions in case you have any questions. But before we start, let me ask the panelists to introduce themselves and then we can get started.
Hi, myself Dheeraj Mittal. I am part of Hiranandani Financial Services. We are into the micro LAP lending business. And in my view, what we can understand about this is another buzzword these days in the industry. Once you talk about digital, AI, ML, and that next thing come what new happening. Everybody talks about, or every second guy in the industry talks about, the co-lending is the way forward, or co-lending is to look forward for. So there's quite interesting things happening across. The regulator has given a lot of options now, and that's how the co-lending looks like. So, but it's a quite nascent stage at this point in time. And there are multiple combinations NBFCs and banks are doing. And to look, in general, if I have to give my view on that, the first thing comes that what is the difference in an NBFC and bank and why there is a need of coexistence. So at the end of the day, all the NBFCs goes to a bank for their onward lending. So technically banks are my lenders. So all the NBFC goes to the bank, take the money, and then they leverage on their capital and go to the market. And they, again, lend to the end customer. So currently is happening in a different fashion where I take the one-time money from a bank and then I do a retail lending to an end customer. In co-lending model, the same thing can happen at a transaction level. And that's what everybody is trying to do and everybody is trying to create. The whole concept remains around that every transactions is originated where a bank and NBFCs are sharing a particular ratio, which normally is 80-20 as defined. So everybody is sharing that risk ratio and doing that. But the whole thing is a very, very new concept at this point in time. That there are technology getting build up for that, how bank will book in their balance sheet, or it's just a balancing funding for the bank, and rest all origination till collection is done by the NBFC. So in a nutshell, it's like providing a strength or a balance sheet strength for the NBFC through the bank. So for NBFC, it's a new kind of a model that's any which was needed for NBFC, and they can leverage more better on their capital and their market distribution, their depth. They can go in more bigger market. They do penetrate their customer and get that. So that's in a nutshell I could understand. And there are a hell lot of challenges we'll discuss and a lot of an opportunity we'll discuss during our discussion. This is my point of view. Steve.
Yeah, so I'm Steve Hardgrave and work with Varthana. Varthana is a specialized lender in the education space. We actually focus on lending to schools and also to students. And so as such, it's not a segment that banks are completely comfortable with at this point, though that is changing. And I would say maybe on the panel, I'm probably the resident skeptic when it comes to this. And I think Dheeraj has laid out the landscape correctly in the sense that broadly speaking, banks have the capital and the liquidity and low cost capital at that. And I think as we discussed earlier, they actually have very good distribution physically, usually throughout the country in terms of branch network and what have you. But they don't have distribution DNA. And in some cases, they don't really have an understanding of some of these newer spaces where innovation is occurring. And in this way, I find it quite ironic, this term that we often in the NBF sector get framed with, it was mentioned earlier today, the shadow banks, right? Which makes it sound like we're lurking around in the dark doing nefarious things. And I would propose actually that all of this that's trying to be done is actually because the banks are shadow lenders. They really are not in the spotlight of lending. They might be banks, but we're, as NBFCs, generally at the front in the limelight, out there dispersing loans. And banks are in the shadows trying to find a way to deploy capital without actually having to lend to some of these segments. And so I think the challenges and the trade-off is, if they want to make it seem like banks are dispersing granular individual loans, it's a nice trick to do that. But if there's a way of managing granularity and risk, we have term loans, we have PTCs, we have direct assignment, and you can dial in, whether you want to select a specific pool or not, or take exposure on the NBFC. And so I think it's great. It's a nice, we need to throw the whole kitchen sink at this issue. But it's another feather in our cap, and it's only interesting for us to the extent that there's a lot of friction with banks in the other areas as well.
Steve, thank you, and this is wonderful. This is the first time I've heard someone call the banks as shadow lenders. I'm an ex-banker, no offense taken, but you have a point there. Neerav, we are just introducing ourselves to the audience, so if you can take a few minutes.
Sure. Hi, my name is Neerav Choksi. I'm the co-founder and CEO of Credible. We are a working capital tech platform, so essentially we work with large anchor corporates on one side and financial institutions on the other to enable working capital financing for vendors, dealers, distributors, SMEs of these ecosystems. Almost 98% of all the loans that we disperse are through bank balance sheets. So, I have a little insight into how banks think about partnering with NBFCs and fintechs in general. And that trend is changing. You're seeing banks being far more proactive in terms of the way they want to partner with new age companies and new age lenders. That being said, I think co-lending is still slightly far away in the future, primarily because of the way banks look at exposing their balance sheet. So even if you were to kind of want to partner with a bank, they'd either prefer that you become a DSA for them and originate business, or you underwrite much of the credit risk by giving an FLDG or giving some sort of credit enhancement, and then they'll try and piggyback along those lines. I think co-lending works to a certain extent in traditional products like housing finance and maybe secured term loans, LAPs, those kind of things, which the bank has understood for many, many years. But more exotic products like what Steve is doing or what we are trying to do, I think we're a little far away in the future. And we'll talk about why as we go on, but that's just my perspective.
Thank you. So I think the panelists have introduced themselves and given their opening comment. Let me just introduce myself. I am Sanjay Sharma, and I run a company called iFinance, which provides loans to micro enterprises which are in the unorganized space. These are the small enterprises in the tier 2, tier 3 cities. And we have, over the last 8 years, given more than 450,000 loans to these enterprises and seen a very good credit uptake and a very good credit portfolio. So getting back to the objective here, clearly if we have to become a $5 trillion dollar economy or $10 trillion dollar economy, it cannot happen unless there is enough credit access, and credit access is given to segments that today are deprived from the adequate access to credit. That is a given, everyone knows that. The second is that over the years, NBFCs have played a complementing role to banks in reaching out to those excluded segments or less service segments. So that is the platform on which we can look at co-lending. Co-lending, I see it as one of the exigencies that was created during COVID, when RBI came in and introduced a policy for co-lending in 2020. And the idea that under which the policy was made was that RBI wanted a quick flow of funds to the priority sector and to the excluded segments of the country. So that was the essential motive. Before 2020, association between banks and NBFCs used to be there. They used to be called FLDG, bank correspondents, etc. But the co-lending policy created a more level playing field. And then, since then, there have been a lot of talks in the press, a lot of talks in the industrial forums about co-lending. So has this really made a big difference? Has the landscape completely changed? Let me put that as the first question to the panelists, that what do you think? Has co-lending changed the complexion of the industry? Has it made enough gains? And what are those gains? Here, would you like to?
Like I said, it's still early days. While there is a great framework and RBI has spelled out the rules, so to speak, I think the big challenge today is how banks look at underwriting a particular business, right? If you were to partner with a bank as a co-lender, and the ideal situation would be you would agree on a parameterized sort of credit model with the bank. Then the NBFC would go out there and source customers and manage those relationships. And as long as it meets those credit parameters, the bank would disperse fairly quickly without going through another whole process of underwriting. Ideally, that should be the situation. In reality, that's not really what happens. And which is why there is a mindset change that is required at the level of the banks and financial institutions who are large enough. In our experience, we find it easier, to be honest, on the flip side, to work with banks than to work with some of the larger NBFCs. And I don't mean this, no offense to anyone, but the reason again is because larger NBFCs have been kind of traditionally operating more as quasi-banks. And so this is a problem across the board, and it's not just limited to banks. That being said, I think this is shifting in certain parts of the market, like I alluded earlier. It is yet to take shape in more exotic, newer products.
So Neerav, you are saying that it is early days, not much has happened, but things are moving. Okay.
Yeah, I'll agree with Mr. Choksi that definitely things are moving. It's quite an early day, I would rather say that, because a lot of things has to be worked out. The whole challenge currently is, we heard a lot of tie-ups, a lot of engagement is happening between bank and NBFC, but on ground, very far and few transactions are getting booked onto the balance sheets. The whole challenge comes to when it comes to a transaction, does bank has a bandwidth to involve in the transaction level with the NBFC? And that's what the governance model also comes and play something, because current policy says about that both the entity has to underwrite the loan technically, for whether you go on one particular screen of an NBFC and approve it, but your underwriter has to see. So ideally, those kind of nitty-gritties has to be worked upon, and the governance need to be looked upon if we have to just scale up this whole thing. The concept is very naive, and it's like it has to be developed, and it'll definitely go a long way, but it's currently we are taking a lot of baby steps towards that, and there's a large things has to be worked upon. If you really want to make a makeshift difference from a co-lending become one of the alternate product in all the banks and all the NBFC's balance sheet or originating process.
Thank you.
Yeah, I echo those points and just kind of add to it in the sense that there's a lot of upfront of work that needs to happen in agreeing on the credit parameters and the product parameters, agreeing and getting actually systems to integrate and homogenize. And all of that's even before getting to a transaction by transaction level, which again, when the calling card for a lot of NBFCs is being very nimble and responsive, the nervousness is how much is this going to slow down my customer experience? And all of those things are front loaded, and there's usually not a commitment at the front end that we're going to do this until it gets super big, which is when all of that pays out. So I think as everyone has mentioned up here, it's early days and not a lot has happened. With time, I think you'll see people starting to figure those things out and commit to those processes and scaling them up. And hopefully scaling it up, as we've talked as well, you don't want to have just one partner. Just in any case where all of us will be having very diversified sources of capital. And I think that remains consistent as an NBFC. You will not commit to only this. It will be one piece of a portfolio that you manage through sourcing through various different means.
Excellent. I think there seems to be a uniform consensus that things haven't moved as much as they should. There's a lot of song and dance around co-lending, but things haven't really moved as much as they should. They are moving. So my next question to the panelists is that if things have not moved as quickly as they should have, so what's holding it back? What are the challenges? And what can be done about making it a quicker process to take root?
See, I would like to answer these questions and just add one thing, that there is a responsiveness from both the parties. Let's say bank has to engage with NBFC and understand their business model, and then allow NBFC to play as part of the co-lender in the whole model. And that's what, even if you go and see, for an NBFC, either 3 or 4 route to raise capital, right? Or their own capital, or the alternate ways when you go for a borrowing. So you have to, either you can do a DA transaction, what we're discussing in the morning, do a PTC, or do a normal onwards lending wholesale arrangement with them. All of them currently, if I go, there's a lot of time engagement with them happen. And that's what is a roadblock. Even if I think that I go to any bank for that matter, were they interested and do they understand the customer segment which I am operating into? Because the segment, typically what happens at NBFC segment, when the segment at which we operate versus a bank operate, I don't even go to the territories or area and say these are the bank customer. I don't operate in that. Similarly, the banks is to understand these are the territories, area, or the market, and that's the whole model. The RBI wanted to penetrate deep and give it to the right people where bank is not approachable. When I say approachable, no, a small trader or a small shopkeeper or a small kirana shopkeeper owner in a tier 3, tier 4 town, can he go to let's say any bank, whether it's matter for a PSU or a non-PSU, and ask for a loan, and then somebody will service him? Because who is going to service them? Then when he goes to NBFC, rather NBFC goes and asks him whether he want any kind of a credit facility. And that approach need to completely change, because as Steve rightly pointed out, there is a turnaround time related issues. If I have to instantly commit, and policy talks about you have to be transparent that 80% loan is given by XYZ banker and 20% loan is given by me. So I would rather communicate upfront that if bank is not funding, or I'll fund for that matter. So it has to be very transparent and clear process, a turnaround time driven process, and bank has to understand what NBFC is putting on the table, or what proposition they are putting on the platform or in the whole value chain system. Currently, what, as Mr. Choksi rightly pointed out, the bank sitting in a one particular this thing, they are always looking at the NBFCs like how you can squeeze the rates and how you can work out those things and just give a front-end partner. That dimension has to change. The relationship has to be let's say, let me put you in a simpler word, it has to be equal relationship between a bank and NBFC. Because the same thing we are any which way is doing.
So, Dheeraj, essentially, you're saying that the entire blame goes on the banks.
No. I'm not saying that. That's a one part of it. I'm not saying so.
Okay.
I don't intend to say that.
No, I was just joking. I think the sense I am picking up is that, yes, the banks have to trust the NBFC
Number one.
more.
Number two, we have to also build a better technological platform where I can communicate with the banks. So it's not only, that's only one point of the whole value system. Sure. The entire ecosystem has to be built across. NBFC has to be very transparent with the customer and transparent with the bank, that what kind of a profile. Okay. There has to be co-agreed board approved policies by both the entities that this is how you are going to lend. And if you can dimension it, very objective policy, and then arrive it at a conclusion, then it will work on. It definitely is going to stay there. It's not that it's not going to work out. But that nitty-gritties will be evolve over a period of time. That's the only point I'm trying to say.
Yeah. Okay.
Uh,
Yes, Neerav.
I mean, there is everything that I wanted to say, I think Dheeraj has covered. But let me just look at it from the bank's perspective, just for fun. One, of course, look, banks look for size, right? I mean, for anything to be meaningful to a bank, you can't go to them with a 10 crore portfolio and say, hey, co-lend into a 10 crore portfolio, and hope for them to take you seriously. So I think that's one issue that we need to think about from a bank's perspective, that can you give them scale? Second is risk, right? As NBFCs, we are adequately pricing the risk, but banks can't do that. So when you look at a co-lending model, you're looking at 80-20 and you expect the bank to finance it at, say, 10%, and we are financing it at 16, 17, 18%, and we want to keep the spread on the 80% or whatever, right? We have to think about the risk-reward ratio for the bank as well. So this is another challenge that, you know, we've heard from banks talking about. The third is the entire shift in mindset to say that, look, we can do parameterized lending, or we can agree on a policy together and then execute that policy flawlessly, digitally or otherwise. That's not very easy for traditional large organizations to do, but that, I'm happy to say, is shifting. We're seeing changes happen there. You're seeing multinational banks, PSU banks moving towards quicker customer experiences in disbursements and sanctions. And a lot of technology is being licensed out to do those things. But it is still traditional. If you tell them to do term loans, they know how to do it. If you tell them to do LAP, they know how to do it. You tell them to do pre-invoice financing, purchase order financing, try and ask them to do financing schools, secured or unsecured for that matter. They have to go through a whole new product paper, build a team around it, understand, you know, those risk dynamics. So that's what is challenging. So you will hear a lot of banks very upbeat about co-lending in products that they understand, but what they're actually thinking is, this is another glorified DSA model for me, right? So I'm going to get a lot more leads.
Sure.
So that's really how I think the challenges pan out.
Yeah, quickly, I'd just say I think it's great that there's another channel offered up.
Yeah.
And I would say probably the less rigidity and constraints in being able to dial in percentages and risk sharing and rates and what have you, the better. There's no need to put extra barriers. Now, I'm not a regulator, and I know there's a delicate balance of providing too much flexibility and enough guardrails. The only thing I'd say is, alongside this, the constraints around banks being able to do more of what they might be used to doing, term loans, securitization, and getting PSL exposure through all of that. I think the constraints on this flow from banks down to through NBFCs and to the underserved population, the more constraints that can be removed on all of those channels, and then let the right bank with the right NBFC find the right way to partner.
Yeah, so Steve, picking up from what you just said, we're saying that the panel feels that it's an area that has challenges. Obviously, banks have to trust, or NBFCs have to build that trust with the banks. There's an automation challenge, that how do you integrate our systems in, and there's a challenge of servicing the customer with the speed that is needed. But there is a positive side, that as we go along, I think this is going to grow. This is a win-win for both the sides. I'll be opening up for questions after this session, so if you have any questions, please write them down. But my last question to the panel, and I want you to answer it in one sentence. If you were to look 3 years down the line, what do you see, how do you see co-lending fit into your portfolio? So would you say, what percentage of your portfolio you think might be done through co-lending? Or you generally, if you can say that in the industry, what will be the co-lending space in the liability side of lending?
Well, I'll take a shot at it. In the working capital space, which is where we operate, I see a lot more bank interest. because they've traditionally been doing short-term working capital products. So we see at least 20 to 25% of our book being originated and co-lent with financial
20
institutions.
to 25%?
I think more or less same. The whole model is based on 80-20. So I see 3 years down the line, my balance sheet should be 20% to one of the channel. I'll say this is one of the channel, self-originated book and the co-originated book. To initially start with, next 3 years should be 20%, and then it has to grow at a CAGR of at least 10% a year.
Excellent. 20% you said?
Yeah, I'd say the same with the caveat that it'll probably be a little binary. Either it's going to work and it should get to 20, or it won't work and it'll be 0.
So I think 20% to 25% of the total borrowing is substantial. And if it can happen in 3 years' time, that is phenomenal. So I think co-lending does offer a huge opportunity for the NBFCs and for the banks, because there's a win for them too. And I think with that, we close the panel. We are just around time. If there are any questions, we'd like to take some questions. Anyone with questions? Yes, please.
Hi, thanks for the, can you hear me?
Yes, we can hear you.
Yeah, thank you for those insights as an organization which is really looking to be part of the whole co-lending game. A lot of what you said resonates. Agree there are a lot of challenges, a lot of hard work that is required on the integration side especially. But yes, I think there will be some green shoots as well. Just to any one of you in particular, I mean, with the new sort of mood from the regulator on FLDGs, how do you think that will play out on the whole co-lending game?
Anyone wants to take that? I think it's an excellent question, because one of the things that is not allowing co-lending to move forward is this FLDG monkey on our backs. FLDG is all about saying that, you know, the NBFC will take the first loss. And if you are a co-lending partner, you have to be willing to take risk proportionately. The RBI policy clarifies that the risk has to be taken proportionately and the losses have to be borne proportionately. The reality on the field is that we are still migrating into that. Some banks have accepted it, some banks still want to use some clause or something where they can claw back and treat it like a FLDG. I think that mindset has to change, and that is the key, because the day that changes, the NBFCs will feel more or better rewarded, and the banks will also know that it's a partnership of equals. That's my view. Anyone else wants to add?
Yeah, I might come out a little bit differently on this, and some of it goes back to the principle. Generally, if someone's originating and someone's holding the asset, there could be trouble. You know, we've seen over time that spells trouble, and it just takes time for it to accumulate, and then it all blows up. I'm not so opposed to the idea of FLDG. If I'm the one originating and I have the understanding, I'm fine to take that risk, but then let me have the economics to compensate for that risk. So I understand there's abuses of FLDG, and it's gone to extreme levels. I think the way it's been treated is a little bit too harsh, a little bit swinging too far in the wrong direction. But I think there needs to be some curbs on it. But I'm not opposed to the idea of.
So you're saying, show me the money?
Yeah. Yeah, I'll be happy to take the risk. If I'm originating underwriting and I say I know this space, I'll take all the risk. Give me, you can have your nice little margin and you know, live off that. I'll own the risk.
Actually, my personal view is that I'm kind of in your camp, Steve, here, which is especially if you look at the sort of bottom of the pyramid asset class, if you don't allow originators to give an FLDG, it's going to throw the inclusion agenda out of the window, to some extent.
I think I'll discuss with you outside the forum, but if there's any other question, we'd like to take the question. I know that we're standing in between the lunch and the audience.
Hi, my name is Mudit. I run a company where we have built loan management systems which also support co-lending. So the question is, like, in the co-lending, there's a model 2 which is similar to direct assignment. which happens after the disbursement has happened by the sourcing NBFC. So what is the challenge in scaling that model? Like that model looks very simple and it can scale. And what are the challenges that you think?
I don't think the challenge is in the disbursement. The challenge is in the whole mindset of underwriting a common credit policy. I think that is really where the challenge is. Also, like I said, simpler products which banks understand may be easier to do, but you don't service the bottom of the segment with simple products, right? You serve them with more, slightly more exotic products like microfinance or what Dheeraj is doing or what Steve is doing or what we're trying to do to a certain extent, which banks are not comfortable underwriting on a parameterized model. So that's really where the challenge, as this panel we see.
Yeah, I agree with Mr. Choksi. The whole point is DA transactions are there and banks are free to do, and a lot of DA transactions are happening. And the difference between origination is you have some MOB experience on the customer behavior experience once you do a DA transaction. That's the fundamental difference in a co-lending. You don't have that. You have to be a part of the whole game from day one.
If I may add, the primary difference I think is that a DA is just one transaction. So every time you want to do a DA, you'll have to go to the same bank and take their credit committee's approval. Whereas a co-lending is an ongoing arrangement, and that's a beneficial arrangement. It's almost like as an NBFC, I have access to put my asset on the bank's balance sheet. It's an ongoing relationship. So I think that is the primary difference.
No, sorry, my question was like in the co-lending model, there's a model one in which the bank also needs to underwrite
Correct.
before giving disbursement to the customer.
Correct.
But the more popular model has been where the disbursement maybe happens or maybe the sanction happens by the sourcing NBFC, and then parallelly the bank maybe underwrites. And post that complete exercise, the fund exchange happen.
Yeah. That model is very rapidly being disallowed by auditors, and RBI is specifically saying that the model where the bank lends, the NBFC lends first, and then the bank takes that after the loan documentation is done, is being frowned upon, because that's a DA actually. So you are also raising the same point that it's almost like DA because it is DA.
Anything after disbursement has to be treated differently than at the time of origination, both parties. And that's the whole sense of the entire policy or entire RBI guidelines, that co-originate. The whole idea is to co-originate, and you have to be part of it. There's something I'm good at. Let's say the NBFC is good at distribution. They are good at, or fintechs are good at technology. They can lend or underwriting, and that is what the biggest question today is. How do you create a joint underwriting platforms where both the party can sanction the transaction, especially for a large ticket transaction or even for a small ticket transactions? So once we solve that, and that's the biggest roadblock, and the banks are comfortable with that. So there are platforms, but bank has to be comfortable with that, and NBFC has to design more and more innovative and more better platforms so that all the data points are available on one screen, and he has to just click for the sake of it, or go to the regulator also, and regulator has to define a better governance policy rather than transaction level approval. As Steve was mentioning, that he is ready to take that risk. The economics, if plays off, he is ready to take that risk, and then I will underwrite. The bank can immediately confirm, and it has to be, let's say, a board approved policy or something, and a governing model around it. Once we build that governing model, definitely this will fly off. That's my view.
Thank you, Dheeraj. I think we will close it now. If you have questions, we'll still be there during lunchtime. But I thank the panelists. I think it has been a wonderful discussion. Some things that I have also picked up. So I would like to thank all of them, and please give them a big applause.
Thank you. Thank you to all the panelists here. And if I may request Mr. Varun Bhalla, Country Manager India Provenir, to please join us on stage to present a small token of appreciation to our esteemed gathering here. Mr. Bhalla, if you could please join us. Can I have the memento and the magazines on stage, please? So if you could please present this token of appreciation to Mr. Sanjay Sharma, co-founder and managing director, iFinance. Thank you so much, sir, for wonderfully orchestrating this discussion. Can we have a round of applause, please? Thank you. Thank you so much, sir. To Mr. Steve Hargrave, CEO and co-founder of Varthana, thank you so much, sir. It was a pleasure having you with us. Ladies and gentlemen, round of applause please for Mr. Steve. Mr. Dheeraj Mittal, Chief Operating Officer, Hiranandani Financial Services. Thank you, Mr. Mittal. It was wonderful having you with us. And to Mr. Neerav Choksi, Co-founder and CEO, Credible. Thank you, Mr. Choksi. It was wonderful having you with us. Ladies and gentlemen, I know you're waiting for lunch to happen, but let's give a huge round of applause to our panelists here. Can we have a group photograph, please? Mr. Bala, if you could please stay.